Hello and welcome to the Finance Quarter. I'm Andrew Robertson. The stock market has made a terrific start to the year, adding around 8% in less than 3 months, to the point where some people are questioning if the value is still there. One of those people is Sandra Graham from Parramatta in Sydney's West. Sandra has written to us asking if now is a good time to look at investing overseas. Well, for an answer to that question, I travelled to Sydney's North to speak to financial advisor Claire Mackay. Claire, is now a good time to be looking at overseas investments?
We work with clients. We believe that you should always have a consideration for international investments. So, portfolio construction, you should always have a consideration for cash, fixed income, Australian equities, property and international equity.
Why overseas investments?
Because it's diversification. And you can access investments and types of investments that you may not be able to access here in Australia. For example, Australia, other than Telstra, doesn't really have depth in IT or pharmaceuticals. So, you're looking for different types of investments, different types of regions and diversification. You don't want to put all your eggs in one basket.
And I guess with resources and financial stocks taking up 70% of the Australian market, that limits diversification here.
Indeed.
The United States market is at a record high at the moment, and some might argue it's more fully valued than the Australian market. So do you see the US market as a place to avoid at the moment?
Well, you could say that it's at historic highs. The alternative is that you could say it's back to where it was pre-GFC. Now, markets, the US and the Australian, and indeed all markets, go up and down. But when you look at the overall trend, the US market has continued to increase. The question is, where do you see growth in the short to medium term? Now, our belief in our investment thesis for 2013 is, for international equities, we do recommend a preference to the US and to emerging markets. Despite the doomsayers, we do not believe the US should be written off just yet.
Now, having identified where you want to invest, what's the best way to do that from Australia?
It's a bit like when you invest here in Australia. You can have a choice of direct investments, managed funds, or ETFs, exchange-traded funds. Now, when it comes down to what type of investment you're looking at. If you're looking at a broad market exposure to, say, the US, the S&P 500 is an index, and you can access that via an Australian listed ETF.
I'll just stop you there for a minute. There'll be many people watching this who'll be thinking, ETF? What's that?
An ETF is like a share. It's traded on a stock market.
It's an exchange-traded fund.
Indeed. So it's a fund structure, but you buy one share, one unit, and it replicates the index after which it's named. So an S&P 500 is the US 500, and it is replicating the market based on capitalisation. A managed fund, you're actually paying someone to pick and choose specific stocks in the US market, whereas an ETF follows the index. It's akin to passive investing.
And to invest directly in the US market from here?
We have clients who do that. However, it requires a lot of time and consuming. It's just like direct investing here in Australia. To choose one share, you have to know all about it, all about its competitors, its upstream, downstream, and it actually can be quite costly and there's a fair bit of paperwork. So for an Australian-based investment, most of our clients do it via either a managed fund or an ETF.
Do exchange-traded funds and managed funds suit different sorts of people?
I think it comes down to the actual underlying investment is more a critical discussion. So if you're looking to invest, say, in small caps, US small caps, studies have shown that fund managers who specialise in small caps would generally outperform the index. Whereas when you're looking at a broad market exposure, then the index, when you take into account fees and the like, most fund managers will struggle to outperform.
And just on that issue of fees, what are the costs for investing overseas and what are the tax implications?
Well, the costs are the actual cost of the investment. So if you're looking at a fund manager, their fees. If you're looking at an ETF, they have a fee. They're considerably less than fund manager fees, and they can range from 9 basis points through to 90 basis points. A managed fund is going to be considerably more expensive than that. The tax implications are that you do have international exposures, and there's paperwork that's required to be done for international investments, and there's also reporting here in Australia as an Australian investor.